Okay, so I ended the last part of my speech talking about subprime mortgages, and I just explained what a subprime mortgage was. And now I'm going to go on and talk about some more complicated financial stuff, which I can't do off the cuff. I'm afraid I have to read it. Okay. So at the beginning of this century, the Lehman Brothers, along with many other financial firms, branched into mortgage-backed securities and collateral debt obligations. More complicated terms, let me explain. A mortgage-backed security, the acronym of which is MBS, is an investment similar to a bond. So remember, a bond is basically a debt. So somebody buying a debt, we buy debt nowadays, crazy. That is made up of a bundle of home loans bought from the banks that issued them. So to make this simpler to understand, imagine you've got a bundle of sticks, and then imagine sticks aren't sticks, they're actually mortgages. So you've got a bundle of mortgages, and that you just bought this bundle of mortgages from a bank because the bank promised to pay you back eventually and pay you interest while you're waiting to be paid back. So it's a very risky investment indeed, especially with all those substandard borrowers taking out mortgages. Now, a collateralized or collateral debt obligation, the acronym of which is CDO, is defined as a complex structured finance product that is backed by a pool of loans, so a bunch of loans and other assets, and sold to institutional investors. So I'll try and explain that in basic terms based on my own limited understanding, and I would kindly ask any of my learned colleagues here to correct me if I'm wrong. So investment banks pull together a portfolio, and basically a portfolio is just a collection, so so they pull together a portfolio of what were once termed as junk bonds, so basically unreliable or not very reliable loans that maybe won't give a big return or whatever, might not get paid off. And they sell them off as a bundle, and they guarantee to repay the value of the underlying or the original assets if the issuers of these original bonds default on their payments. I'll try and explain it. Imagine I say to you, I've got this amazing business plan, and I need you to just, I'm going to selling out bonds so that you can. No, forget that. That's a really bad explanation. Just stick with what I said earlier. So an unreliable or not very reliable loans, and they sell them off as a bundle, guaranteeing to repay the value of the underlying asset if the issuers of the original bonds default on their payments. So it sounds like a risky business, and indeed it was. For me, it's very hard to imagine why investors would take such high risks. But I guess the attraction for them was the high interest rates paid on subprime mortgages, so higher than usual. And I guess this is a world of rich people. It's like, there's no point in me investing in anything because, I don't have enough money to make a return worthwhile, any interest paid. So any interest paid is only worthwhile to extremely, extremely rich people that have so much money they don't know what to do with it, so they want to put it somewhere where it's going to make more money. So as for the people taking out the mortgages, the attraction was that many ordinary people could finally start climbing the property market ladder. And then obviously there were large construction companies saw that there was money to be made in colossal housing developments. So they take out huge mortgages expecting to sell off the real estate. In 2003 and 2004, with the US housing bubble well underway, Lehman acquired 5 mortgage lenders, along with BNC Mortgage and Aurora Loan Services, which specialized in so-called Alt-A loans. So this is a loan made to an individual or company with a risk profile falling between prime and subprime. So a sort of, maybe you might be okay to lend to a person. At first, Lehman's acquisitions seemed to have been intuitive. The Lehman's real estate business enabled revenues in the capital markets unit to surge 56% from 2004 to 2006. The firm securitized $146 billion worth of mortgages in 2006, and that was a 10% increase from 2005. Lehman reported record profits every year from 2005 to 2007. So in 2007, its revenue was $19.3 billion, and its net income on that revenue was $4.2 billion, which means that's once you take away all the outgoing costs, taxes, expenses, etc. $4.2 billion. In February 2007, Lehman's stock prices reached a record of $86.18 per share, meaning that the company was worth almost $60 billion in total. By the way, stock just means all the shares together, and often stocks and shares are used interchangeably. It's like if you think about a cake, stock is the whole cake and shares are the slices. The origin of the word actually goes back to cattle, the entire herd being the stock, but let's not get sidetracked. By the first quarter of 2007, however, cracks in the US housing market were already becoming apparent. Defaults on subprime mortgages began to rise to a 7-year high. That meant that all these not very trustworthy borrowers were living up to their reputation and not paying their mortgages, their mortgage payments. So on March the 14th, 2007, a day after the stock had its biggest one-day drop in 5 years, on concerns that rising defaults would affect Lehman's profitability, the firm attempted to calm the waters. It reported record revenues and profit for its fiscal first quarter. Following the earnings report, Lehman said that the risks posed by rising home delinquencies, in other words, people not paying their mortgages, were well contained and would have little impact on the firm's earnings. In August 2007, however, the credit crisis erupted and Lehman's stock fell sharply. Another financial institution failed, and that was Bear Stearns. During that month, Lehman Brothers eliminated 1,200 mortgage-related jobs and shut down its BNC unit. It also closed offices at Alt-A lender Aurora in 3 states. But even amidst these troubles in the American housing market, Lehman continued to be a major player in the mortgage market. In 2007, Lehman assumed the risks of more mortgage-backed securities than any other firm, accumulating a $85 billion portfolio, and that was 4 times its shareholders' equity. By the way, equity is the amount of money that would be returned to a company's shareholders if all of the assets were liquidated. Liquidated just means turned into cash. And all of the company's debt was paid off in the case of liquidation. Very complicated. So in the fourth quarter of 2007, Lehman's stock bounced back, as global equity markets reached new highs and prices for fixed income assets staged a temporary rebound. However, the firm did not take the opportunity to cut down its massive mortgage portfolio, which, with hindsight, would turn out to have been its last chance. Its large mortgage securities portfolio made it highly susceptible to the deteriorating market conditions. On March 17, 2008, due to concerns that Lehman would be the next Wall Street firm to fail following Bear Stearns' near collapse, its shares plummeted nearly 48%. And here's some more figures. On June the 7th, 2008, Lehman announced a second quarter loss of $2.8 billion and reported that it raised another $6 billion from investors by June the 12th. It also took a number of measures that are too complicated for me to understand right now, but in any case, it's sufficient to know that it was all too little too late. Over the summer, Lehman's management made unsuccessful overtures to a number of potential partners. The stock plunged 77% in the first week of September 2008, amid plummeting equity markets worldwide, as investors questioned CEO Richard Fall's plan for the company, the Lehman Brothers. Then there were hopes that the Korea Development Bank would take a stake in Lehman, but they were dashed on September the 9th. And the state-owned South Korean bank put talks on hold. In the days that ensued, the company's stock prices continued to plummet, and Moody's, the most prestigious credit rating company in the world, decided it would review Lehman Brothers' credit rating. So Lehman Brothers risked being considered as subprime. Floundering attempts to save the bank proved to be futile, and on Monday, September the 15th, Lehman declared bankruptcy, resulting in the stock plunging a further 93% on its September the 12th value. So this caused a financial tsunami across the globe and largely contributed to the Great Recession, but that is the subject of another speech. Thank you for listening.